In today's global economy, taxes don't just shape government budgets. They also influence how and where billions of dollars are invested around the world. At the heart of these intricate decisions is something called tax arbitrage. It's a legal strategic maneuver that global corporations and investors use to cut down their tax bills by exploiting differences between different countries' tax systems. While tax arbitrage may be legal, it often sparks serious debates about fairness, economic distortion, and whether developing nations are being shortchanged in the process. In this video, we will explain how tax arbitrage really works and highlight its profound effects on cross-border investment decisions and developing economies. We will also use real-world cases to illustrate how it's reshaping the strategies of multinational enterprises. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of TaxMobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Let's start by understanding tax arbitrage mechanisms. At its core, tax arbitrage involves legally reducing how much tax is paid by taking advantage of the differences between countries' tax laws. Common strategies used by multinational companies for tax arbitrage include jurisdictional rate arbitrage. This is when profits are shifted to countries with very low or no taxes at all, like the Cayman Islands or Bermuda. Hybrid mismatch exploitation. This takes advantage of differences in definitions across borders. For example, an instrument might be considered debt in one country and equity in another, thereby allowing companies to claim interest deductions in one place while avoiding taxable income in the other. Double non-taxation loopholes. Here, income is structured in such a way that it escapes tax both in the source and resident countries. Treaty shopping. This involves setting up intermediate holding companies in countries that have favorable double taxation agreements like Mauritius to benefit from reduced withholding taxes. Case study: Google's double Irish with a Dutch sandwich structure. Google famously routed billions of dollars in royalties through Ireland and the Netherlands to Bermuda, taking advantage of differing tax treatments. This helped it avoid billions in taxes annually before policy changes in the European Union and United States closed the loophole. Now, let's consider how tax arbitrage influences global investment behavior and economic distortion. 1. Surge in investment through low-tax jurisdictions. Countries like Mauritius, Ireland, and Luxembourg became top destinations for holding companies not due to market fundamentals but tax advantages. 2. Capital misallocation. Investments may be channeled into jurisdictions with low taxes but limited economic activity, distorting real market signals. 3. Boost in after-tax returns. Tax savings from arbitrage inflate the return on investment, which can incentivize more aggressive tax planning. Let's consider an example case study: Mauritius route into Nigeria. Many private firms invested in Nigerian fintech and energy sectors through Mauritius-based entities to benefit from Nigeria's Mauritius double taxation agreement provisions. With the introduction of stricter limitation of benefits clauses and treaty renegotiation, this route has become less viable. While tax arbitrage might seem like a smart move for investors, it comes at a steep cost for governments, especially those in developing economies. The implication of tax treaty for governments and tax administrators. 1. Loss of tax revenue. When profits are shifted offshore, countries where the real economic activity takes place, especially in Africa, often lose significant tax revenue. 2. Heightened complexity and compliance burdens. Modern tax structures are incredibly complex, making it hard for tax administrators to detect tax avoidance schemes that involve intercompany pricing, intellectual property transfers, or strategic reinvoicing. 3. Dispute risk. Disputes arise around the allocation of taxing rights, especially where double taxation treaties lack clarity on substance and beneficial ownership. Let's take a look at a key case study: Vodacom versus South Africa Revenue Service (SARS). SARS challenged Vodacom for profit shifting through a Mauritius-based subsidiary, highlighting how treaty shopping can be curtailed when the economic substance of such arrangement is called into question. Global and regional regulatory responses. As the consequences of tax arbitrage continue to strain public finances and challenge fair tax competition, the international tax community, led by the OECD, has responded with sweeping reforms to limit abusive arbitrage. These include OECD BEPS actions, including Action 2, Hybrid Mismatches, Action 6, Treaty Abuse, and Action 13, Country-by-Country Reporting and Transparency. Multilateral instruments. This enables quick amendment of multiple tax treaties to curb treaty abuse and introduce anti-avoidance standards. Global minimum tax. Pillar 2, aimed at establishing a 15% minimum effective tax rate for large multinationals to reduce profit shifting incentives. Case study: Nigeria's BEPS compliance measures. Nigeria implemented country-by-country reporting regulations for multinationals aligned with BEPS Action 13 and began renegotiating treaties with Mauritius and UAE to include LOB clauses, minimizing treaty abuse risk. Local impact and regional examples. Despite the global reforms, the unique nature of different nations results in varying level of implementation and effectiveness. 1. Africa's unique exposure. Due to weak enforcement, limited administrative capacity, and an over-reliance on tax treaties, African countries face heightened risk of base erosion. 2. Policy evolution. More countries are modernizing transfer pricing regulations, renegotiating double tax agreements, and developing local anti-abuse frameworks to protect revenue. A striking example is Kenya's double tax agreement renegotiation with Mauritius. In 2019, Kenya terminated and renegotiated its treaty with Mauritius after it was used to shield billions in capital gains and dividends from tax. The new version introduced anti-abuse provisions and stronger source-based taxation. In conclusion, tax arbitrage will remain part of the global investment playbook strategy, but the era of opaque tax havens and artificial structures is steadily fading. Today, multinationals face growing pressure to ensure their tax practices reflect real economic substance and value creation. For African and other developing economies, especially those under the African Continental Free Trade Area, after tax policy reform must go beyond drafting new laws. It demands administrative capacity, regional cooperation, and robust dispute resolution mechanism to counter arbitrage-driven erosion of tax bases. Ultimately, effective cross-border investment depends not just on tax efficiency but also on sustainable transparency and equitable taxation practices that support long-term development goals. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.